So let's try to make the skies a little bit more clear and bring in our opening guest, Jenny Johnson, President and CEO of Franklin Templeton, one of the largest global investment managers in the world, more than $1 trillion in assets under management. Jenny, appreciate you coming on. By the way, as you probably know, we're also waiting on details from the Fed's latest monthly beige book number, so we'll probably have to interrupt you politely at some point. Then we'll come back. Thank you for your patience. Jenny, that said, speaking of the Fed, what do you think is going to drive global stock markets in months and quarters to come?
Well, I think you said it, right? It's tariffs, it's innovation, right? So I think as we see continued productivity improvements in companies, you're going to see that translating into the bottom line. You're going to see, I think we're going to have a continuation with the AI theme and the Mag 7 and the improvements, and the growth there. And I think that the economic numbers, and the problem with the economic numbers is what we're learning is actually the government's pretty antiquated in how it collects these numbers. And so there's a lot of revisions, and so that'll tend to have short-term volatility. But I think you have to kind of see through them. Jobs number on Friday, non-farm payrolls is going to be really important. That'll probably inform the Fed, among other things, as far as their September decision. So I think all those factors are key to this. I
got to imagine your clients are feeling pretty good because the markets are at record highs, balances are at record highs, 401ks, 529s, retirements, IRAs, Roth IRAs, any acronym or number I can throw at it, Jenny, it's probably close or at a record highs. But does that also make people more nervous? You're feeling good, but I do wonder if you're kind of a little more jumpy about things because we have done so well the last few years.
Well, I think that's right. I mean, I think when people, ask certainly me about where I see the market, I say I'm still cautiously optimistic, which I actually think was the prior guests used that term as well. Why? Because, the consumer is still strong. They're still spending. You look at high yield spreads, they're really tight. So it's a sign that people have a lot of confidence in the economy. But, the market's also at something like 21 times 26 earnings projections. And so, it's a somewhat expensive market. But then I look at it and say, and then, of course, you have all this noise around things like tariffs, which I think make a lot of people nervous. Although, let's face it, I think companies and the economies have adjusted pretty well to the tariff story. And it hasn't been as big of a deal as people thought it would be. And then, frankly, I am such a fan of the innovation and the AI, and we are not seeing that yet in productivity. We're seeing productivity numbers improve. Last decade, companies, it was like 1.5% was their productivity gains. That's up to 2.5% now. And I can tell you, even at Franklin Templeton, we're just really starting that AI story, and it's going to take time for that to play through.
I do wonder, you mentioned tariffs. I do wonder, Jenny, if the bigger risk to the stock market is the tariffs staying on or the tariffs going away. Because if the Supreme Court agrees with the appeals court and wipes the tariff, everything we've talked about for 6 months, pretty much now gone, some companies will celebrate, others won't. But the bond market yesterday made everybody jumpy. And I wonder if that's a bigger risk. What do you think?
Well, so first of all, I think it's really important to think about what tariffs. So the big issue was we got the big, beautiful bill passed, right? So that gave a lot of certainty around fiscal policy. That was really important. And remember, tariffs were not part of the calculation as far as the government debt that we'd see post-tariffs. Matter of fact, they were going to help improve it. So if immediately all the Supreme Court votes and says we're going to get rid of tariffs, I think in 2024 tariffs we collected $80 billion. We're already over $100 billion year to date as far as what we've collected from tariffs. But that's not in the calculation. So let's just imagine it goes away. We already sort of accepted that there's another 10-year number of somewhere between $2.4 and $3 trillion added to the debt, which is a whole different problem. And then if you think about it, again, it depends on where you're sitting. If you're U.S., only 14% of the economy, GDP, is associated to exports and imports and 11% to exports. If you're Germany, it's 50%. So again, actually in the U.S., tariffs aren't that big of a deal. We haven't exactly calculated what the impact will be on earnings, but actually historically companies, it takes them a little time, but they figure out ways to adjust their supply chain to either absorb that and kind of reroute themselves or be able to pass it on to the consumers. So I don't think from an economic standpoint it's going to be a massive deal as far as the story.